Hey there, everyone. Happy Friday, June 20th, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a beautiful day here in Southwest New Hampshire. Almost done with a wonderful week up here in the hills of New England, making music with some of my old friends and a lot of new friends here from around the country. It's been an awesome week, a fantastic, just creative time to step away from the normal day-to-day routines, focus on playing, singing, composing, arranging, learning. Really fun. And I would encourage you, whatever your creative outlet is, don't let your age or your situation, prevent you from enjoying that, making that a part of your life. I wish I could do better with this, and I wish I came up here way more often than I did. But I'm happy I'm here now. I'm also happy to be joining with you today to answer some of the great questions I've received from all of you guys this week. It's been kind of a weird week. Usually we have a lot of questions going during our live streams. And again, I appreciate you guys being patient this week as I shake things up a bit. But I did receive some really interesting questions, both during the broadcast and also people watching the replay on our YouTube channel. I've got 6 questions here to go through with you very quickly. But first, shall we just do a quick check on the markets here on Friday? So one of the questions you're going to see in a moment deals with futures expiration, which was today. Today was a triple witching day, so a lot of expiration. At the end of the day, though, the S&P basically chopping to the general downside through the course of the day. The S&P did briefly push above 6,000 right out of the open, but after about the first 15 minutes, that was it. And the whole rest of the day was more a period of distribution. The S&P didn't have that bad of a day, finished down just under 0.25%, but that's back below 6,000, so around 59.68. You're certainly not getting this upside follow through that I'm sure the bulls were hoping for, sort of this nice upside follow through Fed week. Not getting it. This is still more of a market that appears to be kind of sitting on its hand. It's not really breaking down a ton, although you do have stocks like Alphabet breaking their 200-day moving average today. But generally, things are kind of flat to slightly lower, right? It's sort of not a fearful, aggressive distribution, but certainly not any sort of accumulation phase. And so we're sort of in a brief give back kind of phase for the S&P. The Dow did end up slightly higher, and the Nasdaq led the way lower, down about 0.5%. Mid caps were slightly higher, small caps slightly lower. The VIX did remain just above 20. Thursday ended the day just above 20, and today pushing about a half a VIX point higher. So the VIX technically in our high volatility range, above 20 going into the weekend. We'll see what happens with news flow. Obviously, quite a volatile situation in the Middle East that continues to be evolving, of course. So who knows what the headlines will be like between now and Monday. But certainly that's something we'll keep top of mind for sure as investors. Looking at the interest rate environment, you can see the TLT, which is a proxy for bond prices, slightly lower today. Not much, though, 0.2%. You can see the yield curve generally drifted lower. The 10-year point finishes the week just below 4.4%. The long bond yield just below 4.9%. The dollar really not much of a change from Wednesday's session. As a reminder, as you probably know, Thursday closed for the Juneteenth holiday in the U.S. All right, looking at the commodity ETFs, we can see the DBC was slightly higher, and that's mostly from energy prices. Crude oil was up about 1% using the USO. Gold flat for the day, silver down a little bit, 1.7%. Natural gas prices were lower. Looking at cryptocurrencies, not great. I mean, Bitcoin actually pushed up earlier in the last 24 hours, but during the equity session, which is kind of this part right here, you can see it drove lower. During, sort of in the middle and in the last couple hours, you can see actually Bitcoin's rallied a bit off of an intraday low. Currently trading around 103,500. Ether price is about 4% lower today. So overall, not great. Risk assets sort of pulling back, but not dangerous, big drawdown kind of levels. You can see the sector breadth was almost perfectly mixed, right? You had 6 6 sectors higher, 5 sectors lower. The energy sector, number 1, excuse me, the XLE up 1%. Consumer staples, number 2, up 0.7%. Financials, number 3, up 0.3%. On the downside, materials down 0.7%. Communications services, the XLC down 0.6%. and then healthcare down about 0.5%. Energy kind of the, probably the big winner, I would say, here recently. Certainly in the month of June, it's been stronger crude oil prices and improving energy prices. The XLE has been one of the worst performing sectors, and here we are at the top. Not much happening stock-wise, but you can see Kroger up almost 10% today. That chart overall had been one of the stronger charts over the last 12 months. We've highlighted a number of times during that period, but in the last month or two, kind of pulling back, breaking the 50-day moving average today, resolving back to the upside, it appears, which is pretty encouraging. The breadth kind of not too bad. It was the worst on the NASDAQ, but overall, you can see most of these are shaded in neutral amber. So sort of some good, some bad, a little of everything here. Looking at the Magnificent Seven leading growth names, Apple up 2.25%. That ends up being the best performer in this group. Netflix up about 0.75%. Tesla flat for the day. On the downside, Alphabet, the worst performer, down 3.9%, that is. Well, look at the chart of Alphabet. What's concerning here is that from a technical perspective, I would grade the recent tactical trend as fairly strong, right? Higher highs, higher lows, but we can see we're breaking down here back below the 200-day moving average. That's just on Friday's session. That's not a great way to end the week, right? About a week and a half ago, or about 2 weeks ago, actually, we powered above the 200-day moving average and then have been sort of stalled out here. And now we're resolving to the downside. So keep an eye on that one. Testing the 50-day moving average. The momentum's still okay, but getting really close to the 40 level, which is kind of a danger sign for us. Just quickly looking at the chart of the S&P, I mean, it's not horrible yet, right? I mean, this is not a, not a super bad chart. Whoops. We can see here, we're still above the 200-day moving average. We're still above the 50-day moving average. Those moving averages are still sloping upwards. We're still above the May swing low. So there's a lot to be excited about. I mean, I think the real problem here is this bearish divergence, which as this week has gone on, I think has more and more clarified the fact that the higher highs from May into June have been marked by significantly lower momentum. They've been marked by significantly lower breadth. And I think those divergences often are leading indicators of a concerning topping formation. 4 out of, actually, that's not true. 3 out of the 4 days this week after Monday's pop higher, the rest of the 3 days, all these black, heavy candles. So 4 out of the last 5 sessions going back to last Friday, all negative closes. The breadth conditions, this is a chart we just called the chart, hitting on some key things. I mean, as you can see, these indicators are not, really negative yet, right? I mean, the advanced decline line is just kind of not going up anymore, but it's really not breaking down. The stocks above their 50-day moving average, not breaking out anymore, but not really breaking down. The bullish percent index, maybe the only one that's really kind of giving a negative look with a bearish divergence and breaking below the 70 threshold. Offense over defense, lower high, but not a lower low yet. So a lot of indicators I would say that had been, pretty bullish, sort of in April into May, now no longer screaming bullish. They're more kind of neutral, right? And just not going up anymore. So I think there's more that could be seen in some of these breadth indicators to transition from a period like we're in now, which is the market moving higher on lesser support, right? Lower, weaker evidence versus a market really breaking down. I don't think we're necessarily seeing that just yet. Going into next week, of course, I think that's obviously top of mind. This is one of those times when I think keeping a wary eye on key levels of support, keeping a wary eye on the line in the sand, as we call it, particularly meaningful. All right, that's just a quick update on the markets here on Friday. Of course, we're going to give a much more thorough review for our market misbehavior premium members over the weekend. And just a heads up to all of you guys, I will see when I can get that report out. I'm going to be transitioning back from music camp in New Hampshire to the other corner of the country over in Seattle this weekend. So we'll see when I can get that out to all of my premium members. Let's get to some of the questions we've received. As a reminder, these questions come from all of you as I'm live streaming the show. Just drop a comment wherever you're watching this on LinkedIn, YouTube, Facebook, or X. And if you're watching it on our YouTube channel, you can put a comment below the video. I check out everything. And you may note if you put a comment on my YouTube video, I respond to 100% of them. And it's something I really appreciate doing. I enjoy hearing your feedback, your thoughts, your questions, and then featuring some of them here. So please keep them coming. I appreciate it a great deal. Here's question number 1. I'm seeing a bearish momentum divergence for Bitcoin on the daily chart and possibly, but to a lesser extent on the weekly chart. Would you agree? We've been talking about divergences a lot recently. Sometimes it doesn't come up a ton because the market's not, either in a downtrend where you're not having those divergences, or you're just seeing the market strengthen on stronger momentum. And I think that's what's changed with a lot of charts here recently. We'll take a look at that in a minute. But this chart of Alphabet, kind of the classic bearish divergence. If you want to like bookmark an example of one to refer back to, just to remember that you're looking for the right pattern. Here's Alphabet, December 24 through the early February of 25. Look at the higher price action on weaker momentum, right? Higher prices, lower RSI. That's the bearish momentum divergence. The opposite would be at a low, and I really don't see a good example of that on this chart, but the opposite would be like a lower lows on stronger momentum. That's not really the case here, but if like this RSI low is like there, that would be a good bullish divergence. But Apple is a good chart that actually has a bunch of both divergences over the last couple of years, if you're looking for another example. So the question is, does Bitcoin look kind of like this with higher prices and weaker momentum? That's the question basically that you're posing. We'll look at the daily chart first, and let's just see how it looks here. All right, so here's a chart of Bitcoin. I'm going to zoom in a little bit. I got a lot of data here. Didn't really do much, sorry. All right, so you're basically saying, is this a bearish divergence? So, I mean, you tell me, but I would say no, right? And here's the reason, right? Here's the chart of Bitcoin. So we're actually making lower lows in price. We are making lower lows in momentum. So the momentum matches. I should have kept this other chart here. All right, let's move a couple windows. I swear this will be worth it. All right, here's the chart of Bitcoin. Let's zoom in just a little bit here, like 6 months. Here's the chart of Alphabet. There's our example, higher prices, weaker momentum. You can see how the momentum matches really well, lower momentum, but the prices are actually trending downwards as well. So there actually haven't been any divergences with Bitcoin, at least on the daily chart. We'll look at the weekly chart in a minute, but higher prices on higher momentum, lower prices on lower momentum. That actually just means a normal market. So it doesn't mean the market can't top out. I'm not saying that this is definitely not a top because there's no divergence, right? It's not like every market top has a divergence. It's more the opposite. Most divergences end up in a major top. So, so it's something to look for. You're not going to see it at every major turn. You are going to see it at a lot of them, and that's why I pay attention to them. Coincidentally, on the chart of Bitcoin, I would say you do have a bullish momentum divergence with the lower lows in March and April of this year and higher lows in momentum. You had a great bearish momentum divergence on the same chart, it turns out. November and December of last year, higher prices on weaker momentum. See how this looks very different. This is lower prices on lower momentum. So the answer is no, it's not a great divergence. Now let's look at the weekly chart and see what we see there. And it could be different. That definitely happens. We'll bring in like 5 years of daily, 5 years of data. So on the weekly chart, yes, I would say this is a divergence, right? See how that looks different. Higher prices on weaker momentum. So you are getting a bearish divergence on the weekly chart. You're not getting it on the daily chart. So make sense of that for us. So obviously two different time frames, right? And so this divergence on the longer time frame suggests more of a potential broader topping pattern. And then you look to see if it's validated with further weakness in price. So the problem with a divergence on the weekly chart, it can take quite some time for any sort of drop to actually be reflected on the chart. It may not even come, right? So the weekly divergences, I actually pay less attention to generally, just because it's a much larger time frame. It can take a lot more time, and probably the things you will see on the daily chart end up validating some of that weakness first. So I often find in this sort of scenario, I pay a lot more attention to the daily chart to see if we're breaking down through key levels that would tell me, yeah, we're in maybe a period of distribution. So the short answer to your question is no, I would say not on a daily chart. Yes, I would agree to your assessment on the weekly chart. Suggests maybe, we're at some sort of long-term topping pattern. But again, the daily chart probably more important, particularly with something as volatile and noisy as the chart of Bitcoin. Great question. Number 2, do you ever use ATR, average true range, to assess risk and volatility of a holding and adjust positions based on that info? It's funny. I've gotten this question before, and we featured it. I mean, a different version of this question, but I really love how you asked about, how you assess the risk and volatility of a holding and adjust positions based on that info. So I would say yes, I definitely do, but I don't use the just the actual average to range. Let me show you what I mean here. Average to range. Let me add it to the chart, and then we'll talk about what it actually represents. Average to range is an indicator that basically shows you the average range in points, right? In dollars, if you're looking at a stock like Alphabet, this basically says on average, how many dollars does Alphabet move, right? So this is saying over the last 14 days, the average range of Alphabet is $4.58, right? So that means if you look at the last 14 days, on average, this thing moves $4.5 to $5 to the upside or the downside. It's not saying moving up a level. It's just how much it tends to move, right? What's the range, right? The high to low range. Now, what is a true range? So the problem with a lot of equity charts, if you have these gaps, right? So here we have a gap coming off of the February peak. Here we have a gap back in December. So what do you do with gaps? Average range would be ignoring the gaps and just looking at the daily high to low range. The true range basically means you adjust for gaps. So if there's a gap, you actually include that in the next day's range. And that's why you'll find when there are these big gaps on the chart, you'll often, pretty much always see a big move in the average true range, a big spike, because that just means the range has been jacked up, in one day because of a huge gap. And then as you can see over the next week, assuming there are no further gaps, it's usually a big spike in the average true range, and then the average true range starts to come up a little bit. So the ATR is essentially a measure of volatility, right? So if the ATR is trending higher, that just means we're having bigger volatility, wider moves on average for the stock, bigger, wider ranges. And if the ATR is remaining relatively low, which means kind of a low volatility environment, which is not moving a ton. So very few people use this particular indicator on its own because it doesn't really have any directional value, right? It doesn't really tell you we're moving $4.5, $5 up or down. It just says this is the general movement. It's helpful, I would say. When would you use that? I've seen options traders use that as an idea of just thinking about, what strikes you may want to use with a particular option strategy. Although there are a lot of ways to, sort of back into that, looking at the options data. The Greeks are what as they call them, which sort of addresses some of the expected volatility of different options contracts. But it is helpful in terms of like setting stops, right? So if you think about it, if if Alphabet on average has a range of $4.5, I probably don't want to take a position and put my stop, $2 below my entry point, because what this is telling me is that just the normal day-to-day movement on on Alphabet is about $4.5 to $5. So by putting a stop right in the middle of that range, I'm likely to get triggered just by normal market movements and less because of something concerning. So a lot of people, want to set stops outside of an average true range value because you want to set a stop that is not going to get triggered by like normal volatility, have something like underneath here. So if there's normal volatility that gets worse, it's all of a sudden something more significant that hits your stop. So that's why you want to use ATR. Now, there are other ways to back into that. Use percentages, right? Which isn't in dollar terms, but it's in percentage terms. Or there are indicators, and that's where there's a long way to get to the answer here. The only thing I use relative to average range that I use pretty significantly or pretty often is a technique called the chandelier exit, which is a trailing stop. That's the green line on the price that is adapted. It uses average true range as an input, and it was popularized by Alexander Elder in his books, his popular trading books. And basically is a dynamic stop. So if as the price goes higher, the stop follows it along. If the market gets more volatile, then the stop dynamically adjusts for that. So it tries to sort of dynamically adjust for the noise. And what I love about it is when something's kind of going up and going up and going up, great indicator to watch, particularly something that's just in an uptrend that just keeps going and going, and you're afraid you don't want to leave it on the table if it corrects, and gives it all back. So using this is a great way to kind of follow the trend higher. And then when that chandelier exit is hit, that's when it tells you to exit a long position. Same thing here, like we're making new highs. You watch this, we gap below the chandelier exit. That's a signal. Coincidentally, just triggered today for Alphabet with the drop on Friday. So average true range, interesting. I think an important level. Wouldn't use it as a technical indicator, but I would use it as a way to think about stops. And I use the chandelier exit as a way to do that. Next question: how did geopolitical headlines show up in charts? For example, with defensive sectors, technology, communications, S&P 500. I've had a lot of questions related to this general topic, particularly when you're in a period of time with a ton of news flow. And so how do how do charts reflect that? And that's basically is how do geopolitical headlines show up in charts? So, interesting question. Let's bring up a chart, just the daily S&P chart. So the answer is, it's reflected in a way, right? Is it directly reflect, right? Can you look at the chart and see when different things happened? Maybe, right? There are gaps on the charts that I think tell the story of the markets, right? Any of these big gaps on the S&P, there was news flow that happened, from between one day's close and the next day's open to change where people thought stocks should be valued at any given point. We see this on equities related to earnings, right? Earnings will come out after hours, and then the stock gaps up or gaps down, and you'll see gaps on the chart of the S&P as well. And that's when there's big news announcements. This is when there's like inflation data, right? Or housing data, or a Fed meeting, which usually, of course, happens during the day. So less a Fed meeting is a good example. Certainly recently with social media headlines coming from the president, and those will tend to move things. So comments about or news about events in the Middle East. Those are the kind of things that will move the market between one session's close and the next session's open. So I would say those news events are reflected on the chart often in the form of gaps. News happens midday, of course, and certainly with the sort of tweet-driven market environment we're in here, social media-driven market environment with where we're at here in 2025, intraday moves can happen as a result of posts, and certainly news out of the Middle East is happening during market hours as well. So how do we relate those two? So I would say the chart reflects that often in the form of gaps, in the form of big move days, in the form of big volume days. Those all imply something that's happening. How do we, relate what we're seeing on the chart versus the headline? I don't think because headlines are so frequent and significant right now means you ignore charts. To the contrary, I would say this is as important a time as ever to focus on the charts, because when there's not news happening, it tells you something about the sentiment of the markets. Right? I think the fact that 3 of the 4 trading days this week, the market closed near the lows of the day, I think there's information there. I think that tells you something about general market conditions. If we're all bulled up and people are accumulating risk assets and just thrilled to own stocks, the market should be closing near the highs, right? I'm seeing a lot of more profit taking. I'm seeing more distribution through the course of these days. We're seeing the Chaikin money flow rotate lower. Those all imply, investors not as optimistic at this particular moment, given all these other things. The other thing you have to remember is the theory of technical analysis that I subscribe to. Really, John Murphy popularized this in his book, Technical Analysis of the Financial Markets, with a place of honor on our recommended reading list at marketmisbehavior.com, by the way. He talks about how price reflects, the information that's out there. It's that price has value, and that it represents, the collective opinion of the markets, right? Of Mr. Market, and where we all, all the supply and demand, all the fear and greed, all the optimism and pessimism nets out to a particular price at a particular time. By looking at those prices over time, we can understand when those conditions are changing. And I would say, if you want to understand how investors are anticipating news events, if they're nervous about something, if something happens and they're really excited or desperate or optimistic or pessimistic, I think price is the greatest way to analyze that. That was my long-winded soapbox way of answering your question. All right, we have time for 2 more questions. So let me continue on here. Dave, do you pay attention to the equity futures roll? Yeah. So today, Friday, June 20th, is a triple witching day. Sometimes they're a quad witching day, which actually this one might be. I don't have that in front of me. Basically, the futures roll is, for a lot of futures, once a quarter, they have to roll. So some contracts like crude oil trade every month. They have monthly contracts, right? I'm going to start saying things, and I don't know that I think so, but certain commodities, certain index futures, expire once a month. So there's a monthly contract, like the S&P had an S&P May contract, an S&P June contract, S&P July contract. Others only have quarterly contracts. So there's like, March corn, June corn, September corn, December corn. They expire every 3 months. So the end of the first quarter in March, end of June, third week in September, third week in December. This is the, futures roll, or what you've mentioned, the equity futures roll. So this is basically the triple witching day, where all the main index options, index futures all roll over at the same time. So do I pay attention to it? I honestly do not. If I traded options, if I traded futures directly, and I was actively trading those things, I would definitely pay attention. Because what happens is, on this particular day, just a bunch of market participants that don't normally do a lot with their positioning are forced to do it because certain futures are expiring. So they have to, sort of rotate and roll from one future to the next. So they're forced to buy and sell contracts just to do the normal housekeeping of, keeping a certain position out there. For me, I'm not really trading in those markets directly. And so as a result, I don't pay a ton of attention to it. Does it really impact the equity markets more broadly? Some people would probably argue that they definitely do. In my experience, they don't. There tends to be a little more volume and certainly a little more volatility, particularly in those markets, particularly like in the options market. You'll see that in index futures, but does it really drive things as much as, events in Israel and Iran? Has the Fed doing things, Apple missing earnings? Like, no, those are all way more meaningful. So I think in the order of things that are important to watch, I think of equity futures role as an equity investor. I think of the futures role kind of down there with, I don't know, other things that are just not, the put call ratio. It's like, I look at it occasionally. Do I check it every day and just make sure it has a certain reading? Like, I just don't pay that much attention to it. And it doesn't seem to be hurting my process too much. That's kind of how I would answer it. There are some, and I'm curious if any of you pay particular attention, or if you follow someone that pays a lot of attention, whose insights based on the futures role and the quad witching days do you find really valuable. Drop a comment. Let me know. I'd love to review their work, maybe interview them on my podcast and talk about this. Great podcast topic. Let me know. We'll crowdsource it. If you know anyone that has great insights, whose opinion you really think is really relevant to the quarterly roll, what's called the triple witching, let me know. Leave me a comment. Let me know who it is. I'll bring them on the podcast and I'll ask them. Maybe they have a different opinion. But for me, honestly, I don't pay a ton of attention to it. I used to back in the day when I was working with a lot more of futures traders and going on the floors in Chicago, but not anymore. Final question, and we'll call it a week here in New Hampshire. You mentioned not watching the flickering ticks of the market this week. How do you try to avoid that in your normal routines? I love that so much. There's a lot of stuff that I do with mindfulness, and actually one of the great, not to get too geeky and geek out on music with you, but there are a number of composers who have really focused on listening. As a musician, you're always trained to listen. As a performer, you're always listening with whoever else you're performing with, whether it's an accompanist or other members of the choir, as listening to the soloist, if you're playing with one. I mean, all of that is so important. That's what makes music an experience and makes it sound like one voice and not like a bunch of people doing their own thing. So you're trained to listen a lot, and you listen critically and actively to others to make sure that you're synced up with them. And so there's been a lot of sort of side discussions this week with the fellow attendees about mindfulness and about particular pieces where they're built around listening and playing off each other and what that experience is like, what we can learn from it. And it's natural to think about what that means relative to other things. When I think about the markets, it's so funny. It's helpful in a way to be in a position where you really don't have the ability to pay close attention to the day-to-day movements, because I realize how much on a normal trading day that I'm checking and checking and checking, and like just check 10 minutes later, I'm like, oh, I wonder if it's up. And I kind of look back. How much do you really gain from actively checking that much? I mean, it's sort of like your social media accounts. And how much do you gain from checking a social media account a bunch of times during the day versus just waiting toward the end of the day and checking once, right? How much you benefit from looking at your email nonstop as opposed to checking it once at lunchtime and once kind of in the afternoon. And I bet that's probably good enough for most things. We as a society, particularly with the fact that we have devices in our pocket that have a ridiculous amount of information and connectivity, we are training ourselves to be plugged in. And if you're not plugged in and seeing what's happening, that you're not taking it seriously, and that you're not trying hard enough, you're not being actively engaged. And if there's one thing I learned from this week that I would love to share with you now is just you don't need to pay attention to the short-term moment-to-moment movements. You really don't. If you're a day trader and if that's the game you're trying to play, you probably do need to have your eyes glued to the screen and just be making sure that you're detecting every little bit. That's not what I'm trying to do. I'm thinking more as a swing trader at the smallest amount, at the largest amount, more of a position trader, thinking more longer term. And so it's probably hurts me to pay too much attention to short-term movements because that's going to it's going to orient me to short-term thinking. So to be honest with you, in my day-to-day life, there are a couple things that I do, and I'll leave it here. A couple sort of tips or tricks. Number one, I try to start my day mindfully. Not as an investor, but just as a human being, right? So for me, the morning is super important. I'm a morning person. I try to get to bed early as much as I can with a family and kids and other responsibilities. I really do. I try to get up super early before everyone else is up, and that time is magical. I get ready for the day, shower, do all those things. I get an espresso and I write in a journal 3 pages every day. I have missed very few days in the last 15 odd years of doing that. And it has been probably more than that, probably more like 20 years. And that has helped me so much because it just grounds me in this very mindful, just get all this stuff, things I'm worried about, just get it down on paper and just get it out of your head. And then just focus on like, what are my intentions for this day? What do I want to accomplish? What's important? What do I need to look forward to? What do I need to be prepared for? Where do I need to be when? Where do I have space during the day to take a break and take a breather and reconnect with a loved one or grab a coffee with a colleague or, do whatever and just make sure that I'm intentional about that. So I don't just, fritter away the day doing mindless things. So that's number one is start the day with intention and mindfully. The second thing is start my investing day intentionally. So I always start the day looking at long-term charts. So the first thing I look at, I'm not kidding, every day is this chart. It's a weekly chart of the S&P 500 with my market trend model. It changes very little day to day. Every day, it looks pretty much the same. It slowly evolves, but day to day, it looks pretty much identical. And that's because my goal is to think about those timeframes. My goal at any one point is to have a sense of those 3 timeframes and sort of my expectations, what would tell me that something's shifting out of the trends as I perceive them. But I start there. So I think for me, one of the ways that I avoid getting too drawn in the short term later in the day is because I've started my day recognizing that these are the timeframes that are most important. So later, if I find myself looking at something that's not helping me answer these questions, I go, okay, well, I don't need to do that. So that's a second thing. The third thing I do is honestly, I have a lot of flexibility in terms of how I'm able to schedule my day. A lot of it's preparing for chart this at the end of the trading day. Others, it's doing interviews and all that kind of stuff. So when I set up my schedule for the day, I try to focus on times and think about times. Although I don't schedule them, I do think about times and okay, this is a time I'm probably going to check in. I usually right before lunch. I've often been interviewing someone for a podcast. I've been doing something else. Between those like scheduled things, I usually go back and check them out. Like at the moment I'm done, I hit stop. I thank the guest. They leave. I kind of take a deep breath, kind of look, and then I check them and I look at charts for a little while. And then once I think I have a sense of how things have been updated, I move on. So if you are more of an investor like me, more swing trader or a further time frame, I would encourage you to not think about analyzing the markets as this perpetual thing that you do starting at 9:30 Eastern to 4 p.m. Eastern, and you're afraid to take breaks because you might miss something. thinking of it as you're doing other things and then occasionally checking back in. And then when you do it, you're just thinking about where it was the last time you looked and where it was this time. Thinking of these like incremental additions to the mosaic that you understand on the markets. That's how I do it. So those are three things. It's starting my day intentionally. It's starting my investing process with a proper long-term macro focus. And then third is really thinking about times during the day when I can kind of check back in with the markets, as opposed to staring at the markets all day, which is when I think you get drawn into a lot of short-term noise that you probably don't want to be thinking about. That'll do it. What a great way to end this week here in New Hampshire, doing the show remotely, and end this show talking about avoiding the mindless flickering ticks of the markets and focus on more mindful, intentional practices as an investor. There might be a book in there somewhere. Maybe I'll sketch that out at some point. But for now, I will say thank you so much for watching. Again, I appreciate you tuning in this week as I do things a little differently, allowing me to come to this conference here for the week. Also, thanks in front of everyone to my family for allowing me to do that. That's pretty special as well. We'll be transitioning back to the Seattle area. I'll be back in Redmond for the show on Monday. So expect a normal week next week. But for now, have a fantastic weekend. Thanks so much, as always, for watching. And remember, it's always a good time to own good charts. Take care, folks.